You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? This is Mike from The Moose on the Loose. I hope you are doing well today. This week in Quebec, it's spring break, so I will not be there. I will not be around, but I have recorded a complete series this week, so you're going to have a podcast every day. I thought of sharing my 5 most important investing rules. And the reason why I thought of doing this is, as an investor, you need a framework. If you don't have a framework, well, you're going to hesitate, you're going to make mistakes, but most importantly, you're going to get stuck in paralysis by analysis because you don't know exactly what you're doing. So you're going from one strategy to another, you're buying a little bit of this, selling a little bit of that, and then whenever there's an asset that is not performing after 12 months, you're starting to freak out. Oh, this company is down 15% over the past 12 months, so it's not good for anything. So let's sell it, right? So that leads to a lot of mistakes, or again, getting stuck by not doing much because you don't have any rules to follow. You don't know where to go. You don't know how to set up your plan. Investing is like a journey. If you don't have a plan and an itinerary, yes, of course you can go on an adventure. But at one point, you won't even know where you're going and why you're doing it. So having some kind of at least a North Star to follow is very important. And for me, I decided to keep things super simple. Super simple for the first reason is, when it's simple, it's easy to put in action and to do something about it, right? If it's super complex, it sounds fancy. You sound probably more intelligent than most investors. But in reality, what's the outcome of this? What's your returns? And are you able to make easy decisions, quickly that will improve your portfolio or will avoid losing a lot of money? So that's why I wanted the mind to be clear and to be super simple. So rule number 1 for this Monday is to start all my research based on the Dividend Triangle. And you probably know a lot about the Dividend Triangle already, but today I'm going to provide you with an example of what do I do with those 3 metrics. So the Dividend Triangle is a concept that I literally invented. It's just I kind of noticed that if you put those 3 metrics together, you will eventually narrow down your research very fast. And most companies that are showing a strong dividend triangle, so strong 3 financial metrics, only 3, super simple, they tend to create great businesses, thriving businesses that all the other financial metrics that you're going to look at are going to look great too. And here how it goes. So I focus on the trend of the past 5 and 10 years for 3 metrics only. So revenue, earnings per share, and dividend. So it goes like this. So when you think about that, as an investor, you want to invest in a thriving business, in a business that is growing, right? So the best way to know if a business is growing is to look at the revenue, the sales. If you have a business that is not able to increase its sales, it's going to be super hard to make more profit, right? Yes, you can optimize, but at one point, if you are capped at $1 million per year, no matter how much you improve your business and you lower your costs, you cannot make more than $1 million profit. Yeah, that would be great. But imagine that this company is able to grow its business by 10% every year. Well, that million is going to become 2 and then 5 and then 10 in several years, right? While if you're stuck at no growth or declining, and chances are you're not going to cut down your costs all down the way to 0. So driving business will be a business that has revenue growing most years. Then earnings per share, same thing. If you see a business that is making money by selling a lot of stuff, you also want them to have their costs under control, having some pricing power, and of course, creating some profit. I would love to follow cash flow per share or something like that, but the cash flow is super volatile. if the company has any like some kind of projects, the cash flow will greatly move. As the earnings, yes, it's not as perfect because it's based on accounting principles, but on the other side, it's a lot smoother. So it's easier to follow over the trend of like 5 and 10 years. And you can see the direct correlation between the revenue and the earnings, which is something that I really like. If I see that the revenues are increasing by 10% and then earnings are following about the same thing, it means that the business is able to grow while maintaining their margin. But sometimes you will see a business growing their revenue by 10% and then the earnings per share only grows by 5, which tells you that in order to grow, to increase the sales, the business has to spend more money and then it makes less profit than it used to. So it affects the margin. So it's a relationship between the revenue and the earnings that are super important. And let's be honest, when you see a business that shows growing revenue and then growing earnings, well, chances are their balance sheet is under control, right? Because it's really hard to have like a huge load of debt and have interest charges increasing like there's no tomorrow and still having revenue and earnings growing super fast. So the business must be able to pay off its debt. The revenue and the earnings that are growing will also lead to a business that is generating cash flow, which kind of makes sense. It's kind of like another like derivative of the dividend triangle. And most importantly, when a business is growing its revenue and growing its profit, what I want that business to do is to share their wealth with shareholders. So I want a business that is also growing its dividend. It's a sign of confidence in the business, and it's also a good set of metrics for dividend investors to analyze a little bit more. So this is what I like most about dividend growth investing is when a business is paying a dividend, well, I can analyze the dividend, the yield, the payout ratio, the trend of the dividend growth. So if the company is increasing its dividend by like 10% every year for 10 years, well, it tells me that the business is incredibly doing well, like a company like Visa and MasterCard, for example. But then, if the dividend growth rate started to slow down to 5, to 3, to 2, to 1 penny, well, then there's a problem. So it's another set of metric helping me to understand what's going on. So what do I do with the dividend triangle? Well, the first thing is, of course, I used it in a stock screener to help me identify companies that are thriving. That's like super easy to go from like 1,000 stocks to boom, like 200 or 300 stocks, and then I can filter by sector. So it helps my life a lot about that. But the most importantly is then once I select a company, it's very easy for me to make sure that everything goes well. Here's a good example. You know I'm a big fan of Alimentation Couche-Tard, so ATD.to. Been on my portfolio forever, thriving businesses for several years. I've been telling you this for like, I don't know, a decade probably. But then since 23, the dividend triangle is slowing down. Revenues are not growing as much as it was. The earnings per share are actually like pretty still, even slightly declining over the past 2 years. So it's been maybe like 5, 6 quarters in a row, 7 quarters in a row. I can't remember now that the dividend triangle is slowing down. So we're reaching a plateau. So that tells me, oh, okay, so Alimentation Couche-Tard not doing that well right now. Is it for me a reason to sell because over the past 12 months, the stock is down like 18%? No, it's not a reason. I mean, come on. How many of my stocks have been down like by 20% at one point in the time that I've held them? Probably all of them. And I would have sold like Microsoft and Apple down 30%, 22. That would be a big mistake, right? So for ATD, same thing. I don't necessarily take I will not take a decision based on how the stock price dropped, but now that the dividend triangle have been slowing down for almost 2 years, it is on my radar. I must look at this, and it's going to tell me a lot about what the management is going through, what are their plan, because if they're not taking moves, well, of course, the revenue and the earnings are going to continue to stagnate. And if it's the case, well, then at one point I will drop the ball and I will sell my shares. I'm not there yet, but following financial metrics that are easy to follow is super easy for me to make a decision after that. I just have to put a time frame and say, I'm going to wait until this date. And then by this date, is the dividend triangle is not back in. Well, the financial metrics have spoken, and then boom, I'm just getting rid of the stock. So right now, this is on my radar. I'm following this every quarter. So far, I'm not worried because I have full confidence in the management, but following metrics will prevent me from falling in love with a stock. And maybe it will be time to take some of my profit off the table at one point. So this is why I follow the dividend triangle. If you want to learn more about the dividend triangle and how to use it, you can download Dividend Income for Life Guide at moosemarkets.com/income. You just enter your email. You're going to receive a link to download the Dividend Income for Life Guide. It will explain the relationship of the dividend triangle versus the low yield, the high yield, how to build your portfolio, and even with a portfolio example. So it's a full booklet, a lot of information there, moosemarkets.com/income, or you can go in the show note as well. So, right, Moose, that's enough for today. Tomorrow, we are talking about the difference between the investment thesis and financial metrics and how to buy and how to sell based on those two concepts. All right, stay tuned and stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.